Today we are analyzing Global Payments Inc., ticker GPN. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. They have a market cap of $26 billion, enterprise value of $36 billion, so you see about $10 billion in net debt on this business. That's actually a pretty significant amount considering that's over 25% of the enterprise value. So we'll have to take a look at the overall debt levels when we get a little bit further. They're operating in the IT services industry. Looks like they provide payment technology and software solutions for card, check, digital-based payments. Looks around the world. They have merchant solutions, issuer solutions, and consumer solutions. So authorization, settlement funding, consumer support, chargeback resolution, payment security, various things like that. Enterprise software solutions. The issuer enables financial institutions, retailers to manage their card portfolios through a platform. And the consumer solutions segment provides general purpose, reloadable prepaid debit and payroll cards under the net spend and other brands. Okay. I mean, it sounds like what should be a good business. The beta is 0.99, so that's going to be about just as volatile as the average S&P 500 company. But when I scroll down to this return on invested capital chart, I have a few immediate concerns. Now, from the good side, we'll start from the positive first, is you have every single year is a profit. So they have 20 straight years of profitability. I like seeing that. That's a good sign to have 20 straight years of profitability. Always a positive when you see that as a shareholder. Very positive thing I'd like to see. The downside here is that it looks like they've been getting worse and worse returns on invested capital over time. Now, this could be a few things. They could be actually reinvesting at worse rates of return. They could be making acquisitions that is starting to embed some intangible assets here, goodwill, and other things that is kind of raising their assets without raising their tangible assets, and that could be affecting what we see in return on invested capital. That doesn't mean these aren't real numbers. They are certainly real numbers because that would be the return that you get on your acquisition price. That does still matter. But I don't like seeing, just steady declines over time. Likewise, they haven't had double-digit return on invested capital since 2011, and they've been just steadily getting worse since then. And now you're basically only at break even on your capital, 0.3% for 2022. So those numbers are quite poor. They had a big drop in 2009, but again, that was 2009, so no big concerns. It instantly bounced back. There's probably some sort of one-time write-off. I don't have a concern about that number on its own. It's just this downward trend. I don't like downward trends. It's not a good sign. Obviously, if you're able to turn it around, you can have some really good years over the next 10 years, but that's really hard to predict. Reasonable gross profit margins, they're over 50%. Always a good sign there. Reasonable here as well. Now, return on invested capital is quite low. As I said, the average is 4.7, but the concern here is now when we look at this average, it's not like they're bouncing around that average. We have some years at 6, some years at 3, some years at 4, some years at 5. No, they kind of like passed through 4.7 in 2018, and they've just stayed below it since then. So they're getting worse and worse. That means that their return on equity is also worse and worse. It says the 10-year average is 12.4%, but if we go down here, you can see it's actually 0.5% in 2022, 3% in 2021. So they've not been double digits since 2018 either. So I have some major concerns that this is a relatively low quality business based upon its recent results. The PE ratio looks terrible. On its surface, this would be completely uninvestable. I would not buy a company that's truly at a PE of 234. So why do we see that? We see earnings per share of 40 cents. And of course we have, basically $100 a share. So that kind of makes sense. I mean, that is like over 200 PE because you're trading at a PE, your earnings are less than $1 and you're trading at $100 a share. This is just completely unreasonable. Now, why would it do that? It's because shareholders must think that the average earning power is higher than 40 cents. It looks like if we just average the last 6 years, maybe you end up with a number like $2. Maybe you end up with a number like $2.50. And so if it's $2, it's $2.50, it's still a PE of 40. I mean, it's still incredibly high priced. So this company appears overvalued. That's my initial instinct here. This is an overvalued company. They're trading close to book, but on an earnings basis, it's incredibly overvalued. Now, you do need to know, is this 40 cents real or something else more real? I mean, if $3 is going to make it a little cheaper, now you get down to the 30 range. But none of these numbers make it cheap. There's not even the peak earnings in the last 10 years would say this company's cheap. So I would definitely put this company into the overvalued bucket. Something that is interesting to me is they paid $1 in dividends out when their earnings were 40 cents. A little bit of concern there. That's certainly not sustainable, but if you know this number is going to bounce back, it's not really a problem. You can see that they had operating profit continue to grow, so it suggests there's some sort of one-time issue here because your operating profit was up to $1.6 billion. their overall revenue growth rate looks really good. 2.3 billion to 8.9 billion. You're growing at 15% a year. That means you're going to double every 5 years. It's a really attractive number. So I'm happy with my revenue growth. The EPS growth here, of course, being negative is the big concern. But we might be able to make myself feel better about that as we dive into the financial statements. And so as we do that, please like this video. That is the best way to support the show besides subscribing, and I hope you would do that as well. So let's go into the income statement. Steadily increasing gross profits. That's a good sign. Continuing to get better each and every year. Operating profit continues to get better. You don't see a lot of operating leverage just on the first look because your SG&A has gone up significantly as well. So even though your revenue is up 4x, your SG&A is up 3x. So you have a little bit of operating leverage, but not a ton. Other non-operating income really impacted this. So we see that that's a non-operating expense. That makes me feel a little bit better. It would definitely make me feel better that the EPS of this company is closer to the $3 range than the 40-cent range, especially when you think about the operating profit being higher than 2021. And so that would mean, maybe this company is trading at a PE of 30 or a PE of 25 even if the earnings power is that much higher. So something to be aware of, because if it was at 1.2 billion here, you're trading close to a $4 EPS. That's closer to about a 25 PE. Still more in the overvalued range, but it's a lot more reasonable. I don't like seeing this dilution. This dilution is significant. They went from 156 million shares in 2013 to 300 million in 2020. They basically doubled their share count over the course of a 7-year period. They've bought back a little shares since then, and so it's a little less than doubling. Maybe it's up 80%. But 80% increase in shares is a 7 to 8% per year problem for your EPS growth rate. That is massive. That's absolutely massive. Why would that take place? Again, if they're making steady acquisitions, that could be the reason here. They're taking on these extra assets and they're not self-funding it. They're growing faster than their return on equity. This is always a red flag. You need to be aware of this. Don't grow faster than your return on equity and return on invested capital. It creates a house of cards. It can fall apart later. It's always something that to me is going to signal this isn't sustainable. And so you're going to end up with dilution. You're going to end up with extra debt. Again, we have a lot of debt here. So let's go see that debt on the balance sheet. Wow, just a massive goodwill. I mean, look at this assets. You went from $2.6 billion in assets to $44 billion. You've 20 extra assets. Almost 20 extra assets. Let's 15 to 20x? You've 15 to 20 extra assets. But your income is not up 15 to 20x. Your income's down. Maybe your income's up 4x if we're generous, 5x if we're generous. So let's say your income is up 5x, but your assets are up 20x. That's going to reduce your return on capital. It just is. Now your PP&E is not as bad. Your PP&E is up 6x from 300 million to 1.8 billion. Okay, so from a tangible basis, it's not that bad. But acquisitions are real money. Acquisitions are real dilution. This is why you've been diluted. Is because you can't make massive acquisitions that are so much bigger than your company without having a problem. I mean, so 44 billion in assets. Market cap is 26 billion. It just shows they're taking on debt to do this. Let's see where this debt is. You see 12.2 billion in debt here, 2 billion in debt here. So you have $14 billion in debt. $14 billion in debt against $6 billion in current assets, $1.8 billion in PP&E. So there's $8 billion in assets. Other assets here, 3.6. What is that? Maybe 11. You have negative tangible assets. Negative. Or negative equity on those tangible assets because of this long-term debt and short-term debt. To me, that's a massive concern. This is a second red flag. You have so much debt leveraged on this business. You're just trying to make it work. You want growth more than you want safety. And, maybe that gives it to you, but then it is a concern on what's going to happen in the future. You are spending on your PP&E. It is slower than your depreciation and amortization, which is why when we go here, you can kind of see that they've had some of these kind of declines. Yeah. So you see some decline here in goodwill. You see some decline here from 13 billion in intangibles to 9.6. That's because they're able to amortize some of this past purchase here. But again, you also have really big stock-based compensation, 163 million. What's their income? $100 million here. It's a big amount of stock-based compensation that makes their cash flow look better than it is. Acquisitions here, again, they're probably paying with shares because it doesn't look like they spend a lot of cash on these things. So they're really diluting you to make these acquisitions. Where's this big jump? 2018, 2019. Let's go back here. Yeah, that's your big share dilution. So they issued a ton of shares here in order to make this acquisition. They issued a ton of shares here in 2016, 2017. If you're issuing shares to buy a stock or to buy a company, that means you can't afford to buy the company. Unpopular opinion, but just so. Anyway, I would avoid Global Payments. There's no interest for me in this company. This continuing deterioration of return on invested capital is real. They're taking on debt, they're taking on leverage, they're making acquisitions, they're trying to grow this company as rapidly as possible. That shows a relatively risk-accepting management, so they have a bigger risk appetite than I do. So I would be out for that reason. I don't like the fact that this is deteriorating. I don't like the fact that it's not stable, at least. The actual returns on your capital now are quite low, and that's just not acceptable to me. So for me, I'm going to pass. Hope you learned something. Hit that like button. Please subscribe. Check out at the top here my playlist stocks. The playlist here for my watch list stocks. These are my favorite companies I've found. These are the ones that meet all my standards. I think you'll enjoy those. And if you want to learn how to use this software, quickfs.net. My affiliate link is the first link in the description below. I hope you'll check that out. It's a great way to support the channel by signing up through my link. Until next time, stop paying fees, start building wealth.